Uh, we are live on YouTube and we are starting now our F3 Financial Intelligence for Pediatricians Series 2 under the aegis of Pediatric Academy of Telangana. Today, we are having a very important topic, a part 2 session of Mutual Funds 2 by none other than our veteran and very senior pediatrician, former state president of state of Tamil Nadu, Dr. S. Tirumalai Kolondu. Most of us know him. We have read his books. Also, he has been number of times with us. He took us the part 1, taken us from the basics of mutual funds. And today he'll be talking on mutual funds part 2, trying to give us what are the best category funds, the top 2 or 3 of them. And also for the beginners and the newbies, he will take you step by step to show us how to build a beautiful portfolio of mutual funds with the current available category of funds and their top performing mutual funds. Dear colleagues, you know that this is a WhatsApp group evolvement from Pediatric Academy of Telangana over a period of past 3 years. We have both FIP group, F3 group of WhatsApp. It's a popular group among the pediatricians and doctors. And it was started by under the aegis of Dr. Surendranath and Dr. Pawan Kumar as the Secretary of the State. It has picked up popularity and we have got 5 groups today with more than 1,200 doctors from all over India and world. The group was created by myself, Dr. Ajay Kumar, Dr. Pawan and Dr. Satish Vadapalle from Vizag. Under the aegis, I said, by PATS. And today, after continuing by our second president, Dr. Akkala Bhaskar and also Dr. Yashwantrao Elladi, this is the 3rd year of continuation of this program. This is mainly for the ideas of wealth protection, wealth creation, and discussion between members, providing and share their investment ideas, strategies, and trying to put in their insights, ask questions, discuss various investment related topics, strategies. And that's how we are learning and sharing from past 2 years. And I thank PATS, Dr. Pawan, Dr. RSV Krishna of Twin Cities branch, who was a secretary earlier. Today he is a treasurer, who is our tech savvy person who is making us available on the YouTube, all the recordings of our FIP. It's a close group of doctors and one needs to request to join as a membership, and we are now full. But whenever somebody exits, we can accommodate some people in our WhatsApp group. And I request all of you to share the knowledge, ask questions, discuss, as it is being moderated and modulated by Dr. Harish Gopal sir, who is traveling abroad. Dr. Pawan also is now joined from Australia. It's midnight there, but still his dedication, passion is that he has joined us. He is there with us. Before I hand over, I'll just give a 1 minute of screen share with our presentation of FIP. As you know, we have evolved over a period of 3 years. We started with basics and with newbies, and we are trying to slowly cater to the knowledge, needs, and sharing of amongst the pediatricians. We have got a good faculty, we have got a good admins, and we also have sessions like this where each topic is taken and the question and answers are discussed over a period of time. So if you are able to see my screen, we have named it earlier as Friday Financial Fitness F3 program, virtual education and awareness seminars. Now we are calling it as Financial intelligence for pediatricians. It's a topic by Indian Academy of Pediatrics, State Branch of Telangana, on the personal finance and education and awareness for the pediatricians. We started from 3rd March and today we are doing the 5th topic. We have done by Dr. Indra Pawan, who opened the program with financial planning. We had subsequently Dr. Ajay Kumar Gupta, who talked about insurance. Then we had subsequently Dr. Tirumalai Kolondu sir talked about mutual funds part 1. Then we had Dr. Sindura last Sunday, who spoke about debt funds. Today we are having Dr. Tirumalai Kolondu sir talking about mutual funds part 2, as I have discussed earlier. People ask me why we have to do this as doctors. It is our medicine is the first profession. Our medical profession is our mainline stream to create wealth. But having a knowledge of personal finance, which was lacking even to grown-ups like me. So we thought this is the best way to discuss among ourselves. I now hand over the screen and the platform to Sri Dr. Tirumalai Kolondu sir, and if I have Dr. Pawan online and Dr. Bhaskar sir online to say a few words before we start. Thank you very much. Dr. Pawan? Dr. Bhaskar, are you there? Okay. Okay, so those who have got questions, they can keep it in the chat box and mute.
Dr. Ajay sir, please mute and speak. I've just changed the settings so that only co-hosts can speak. Over to Dr. Tirumalai, sir.
Thank you,
Please
sir.
start your presentation.
Thank
Only
you,
the
sir.
co-host and host can speak now.
Thank you very much. And then any questions, put it in chat box, and for 1 week in WhatsApp, we will discuss about the mutual fund part 2. Thank you very much, sir. Over to Dr. Tirumalai Kolondu, sir.
Sir, once again, I would like to thank IAP PCB for calling me again and again for your financial meet. So I don't know how to thank Ajay sir for keeping a lot of belief on me on my talk. So already we have finished with the part 1 of mutual fund, where we have discussed what is mutual fund, what are the various types, how to enter, how to exit, how to analyze a mutual fund before entering into a fund. See, all these things are there in the part 1. If anybody missed the part 1, they can very well go to YouTube channel and you can see the part 1 so that you can understand the part 2 better way. So with this, I think I will start the part 2. I'll start screen sharing. Sir, is it okay, sir?
Sir, yes, sir. Your screen is visible.
Yes, sir. See, we are starting with the mutual fund part 2. So before entering into the mutual fund part 2, so this is a basic thing I want to say. It's a disclaimer. So the entire talk is based on my experience only. I made a lot of mistakes in my early years. I have corrected myself. I've learned everything in a very hard way. But the pitiable thing is I've learned everything only in a very late stage of my life. So I would like the youngsters and newbies to start learning the basics of personal finance at the younger age itself, so that they will be financially independent at the age where I have started learning about finance. So that is my kind request for them. Second thing, I always feel little worried that I'm talking a lot of finance, I'm giving a lot of financial talks everywhere, but I don't have any financial qualification. So to allay this, recently only I've started with a course in NSC. Then in my course of my talk, so I will be giving some names of the mutual funds. These are all only examples. You need not take this as a strong recommendation. But anyway, all these names of the funds are all supported by well-versed teams like Value Research. Anyway, before taking a decision to enter into a fund, you can consult your own personal financial advisor. This is my small request. Then, what is the cardinal rules for wealth creation? First of all, you have to understand. See, till now, I'm not able to understand few things like the trading, technical analysis, and this Bitcoin, all these things I'm not able to understand. I never enter into this. I never talk about all these things. So only enter where you can understand the thing. So the basic problem with the youngsters, when they want to enter into the equity, say immediately they go to only trading. I know very well only 90% of the people will fail in trading because they don't understand and enter into the trading. So first of all, you have to become a long-term investor in shares. Then only you can understand the nuances of the mutual fund or shares. Then only you can enter into the trading. So you go in the demo, go in the reverse way. Then you plan properly. What are the short-term goals? What are the long-term goals? How much risk you can take in your life? So what are the plan for you to invest in a mutual fund or shares you plan? Then third part is execute properly, invest properly. Fourth important part, this is not sufficient. You have to monitor periodically your investment. You have to adjust your investment. Planning and investing is asset allocation. Planning, you are doing asset allocation. In monitoring and adjusting, you are doing what is called asset rebalancing. Suppose some asset is carrying more of weightage, you come out of that asset and you enter into some other asset class. So asset reallocation you are doing, you are constantly monitoring the fund. So if you follow these cardinal rules, you are never going to fail in your investment journey. See, building a mutual fund portfolio, I am going to make it as simple as possible so that the newbies and youngsters, they can very well understand this. When you build a mutual fund portfolio, you have to concentrate only on three things. Number one, a mutual fund is a long-term investment of 7 to 10 years. You should not do an investment on a haphazard manner. It should be a goal-based investment, number one. Number two, you must know how much corpus you need for each of your goal. So you must need a workup of your corpus. Then you have to plan accordingly to reach the corpus at the age in which you want to retire. That is second important thing. Third thing, whether you are an aggressive investor or less aggressive investor, ready to take a lot of risk, or you never want to take any risk. So based on all these things, your investment should be there. So these three important points we are going to stick on before taking an investment decision. So this is what is called 6 steps of goal-based investing. Number one, set goals, then calculate the corpus. Then 3, prioritize what are all the goals. Then 4, allocate asset allocation. Number 5, investing actually. Number 6, periodically review your investment. So these are the basic 6 steps which you are going to follow in a goal-based investment. We'll go step by step. See, if you take goals, short-term goals, they are for 1 to 5 years. Like first thing you have to do is creating an emergency fund. Next, very important thing, you need a car. I have bought car only after 10 or 15 years of my practice, but it is not possible now. You have to have a car on the day one. So buying a car is a short-term goal. Then buying a house can also be a short-term, or you can take it to the medium term. So these short-term goals, concentrate first. Then medium-term goals of 5 to 10 years. Here it comes your children education, buying a house, and you can plan a foreign trip. This is the ideal period because the love will be more during the early years of marriage. Slowly it will start declining like a right? So yeah, plan for the foreign trip very early in the life. Then long-term goals is a children higher education, children marriage, and then retirement. These three are very important thing. Then you may have your ambition to buy a luxury car like a BMW, or you want to buy a holiday resort. So these things comes under a long-term planning. So this is set goals. Next thing, I have given a small example. How to achieve your goal through a corpus. You need a corpus to achieve the goal. For example, today your age is 30. You want to retire at the age of 55. Let us assume that our life expectancy is 85 years. We are going to make an investment which is going to give a percentage of, say, around 11% CAGR returns. And today your expense, monthly expense is 50,000, or your yearly expense is 6 lakhs. So if you go for a calculator and do some calculation, after 25 years when you are going to retire, you'll be needing per year 25 lakhs for expense. Today it is 6 lakhs. After 25 years, you need 25 lakhs for a 1 year expense. For that, you have to save around 4 crores as a corpus. For that, you have to save nearly 25 to 26,000 rupees every month. So this way, you have to do a calculation. This is for retirement. Similarly, you can do for a child education, child marriage. So finally, you will be arriving at a corpus, how much you need for all these things. Then, third thing, prioritize the goals. I've seen a lot of youngsters, only after 3 or 4 years of, if they are well off from the birth, it's okay. So 4 or 5 years after starting the practice, I've seen people buying a BMW car. They'll be paying a heavy EMI for the BMW car. Is it correct? No. You have to prioritize your goals. So immediately saving for an emergency fund, creating an emergency fund is the first priority. Going for proper insurance, second priority. Your children education, your children marriage, and your purchasing a house or things like that, these are all higher priority. Your luxury car or a luxury home, it comes next. So according to the priority, you start going for your achieving the goals. Then asset allocation. Next, we are going for the fourth step, asset allocation. See, for short-term goals of 1 to 5 years, you have to rely only on fixed income securities like bank deposit or post office deposits are there, or debt fund is there. So for short-term goals, never go near mutual funds. But for a medium-term goals of 1 to 5, 5 to 10 years, you can go for fixed income securities, and you can buy some gold also, and partially you can enter into the equity also very carefully in some funds like a large cap fund or hybrid fund you can enter. So you can have some exposure for equity for a medium-term goals also. But when you take a long-term goals, definitely 70% of your asset should be allocated only to equity to achieve the long-term goals. In this 70%, you can allocate 50% for mutual fund and 20% for stocks. If you are very well-versed in stocks, then you can have more asset allocation for stocks. Correspondingly, you can reduce the mutual fund. That depends on your knowledge and interest in direct stock investing. So this is asset allocation. Then, why do you say the equity for long-term goals? For example, if you have got a long-term goal of retirement for which you are going to save, and if you need 1 crore after 20 years, say, let us have 1 crore after 20 years. If you are going to invest in a bank RD, you have to invest every month 21,000. If the same thing is aggressive hybrid fund, you can save only 14,000 every month SIP as a SIP. That is sufficient. If you are going little more to flexi cap fund like that, you can save only 11,000 per month as a SIP to achieve 1 crore. So if you go for an instrument that will give higher returns of 10 to 15%, your SIP amount is going to get reduced, or you are going to attain your financial independence at an earlier age. So necessarily for long-term goals, you have to invest in equity, either through mutual fund or through shares, or both. Then finally, we are coming to the sixth point, that is review of investment. See, this is very important. Most of us are lacking in this particular thing. So we put and we just forget. So SIP will be going every month from our bank, but we never see whether the fund is performing well or the fund is not performing well. We never see. So at least allot one day every quarter of a year. You go through your fund, how it is performing, any change in the fund manager, any news about the fund house. So you analyze all these things at least once in a quarter of a year. If there is any bad news of the fund house, recently you must have heard something about a popular fund house. In that case, immediately you stop your SIP first. Then, if the news continues for a long time, you just come out of the fund and employ the fund somewhere else. Similarly, if there is a fund manager change, you go through the fund manager previous history, how he was performing in his previous fund. If it is not good also, you have to think whether to continue in the same fund or not. Then periodically watch the portfolio of the mutual fund. Sometimes they'll be loading their portfolio with a higher risk stocks. In that case also, you have to be a little careful. For example, one particular stock has come down recently. Mutual fund which have loaded those stocks has come down drastically. So you have to be careful with your portfolio changes also. Then always do some comparison with the benchmark and peer comparison. How other funds are performing in the same group, how the benchmark for that particular index is performing. These things you have to review every quarter. So I have finished part one of the part two. So goal-based investment and how to build a corpus. How to build a corpus, what are the method of calculation and how to build a corpus. So on a goal-based investment, first thing you are going to set a goal, prioritize the goals, and you are going to calculate the corpus, and you are going to invest and monitor your investment. But these are all very important things in the part one. Part two, we are going to invest based on the risk. I'm going to make it very simple. See, first of all, you decide who you are. Take step one, whether you are an active investor or passive investor. Number one is over. So first decide which investor you are. Then come to the second step, decide about your investing style. You want to be very conservative, number one, or you want to be moderately aggressive. That means you are ready to take some risk. You are an aggressive investor. Number three, you are an aggressive investor. You are ready to take little more risk. So you first decide who you are and what is going to be your investing style. Based on these two decisions, we are going to invest. See, first let us see what is a passive investor, what is an active investor. So passive investor, most of the time, they are very busy people, 24/7. They don't have any time to spend with their family itself. So they don't have any time to read or follow follow the personal finance information. Yet they want to invest in shares directly or indirectly, and they want to earn a decent income of 10 to 12%. So they can be a passive investor. The young people or beginners who doesn't know where to invest, how to invest, initially they can be a passive investor. Similarly, very busy people who have got very less risk appetite can also be a passive investor. Then you have got a very time to read and analyze. There are many analyses coming in our WhatsApp group. technical analysis, lot of technical analysis. Even financial experts, they will leave the field if they see this technical analysis which are posted in our group, thanks to our experts in the group. So time to read and analyze. Second thing, you are ready to take some risk. Of course, nothing is risk-free. Even the marriage is risky, yet we are taking it. Similarly, in life also, you have to take some risk. Then you want to, you are, of course, when you are expecting or anticipating some risk and ready to face it, naturally, you can expect more returns. So say 12 to 15% returns, you can expect as an active investor. Then, first, let us take the passive investor. Passive investor is going to invest in only two things. Number one is the index fund. Number two is the ETF. ETF means exchange traded fund. Same thing as index fund. Only thing, it is trading in the stock market. That is the difference. So either you are going to invest in an index fund or you are going to invest in an ETF. So this is the passive investing. Then what is the difference between an index fund and ETF? This question, whenever I talk in many places, they ask what is the difference between index fund and ETF? This is a common question. See, index fund, there is no need for you for any demat account. Just like any mutual fund, you can have a purchase. But if you want to buy a exchange traded fund, you need a demat account. Then here you can give a bank mandate for an index fund. Every month the SIP will be flowing to the particular fund. So you can either lump sum investment you can do or a SIP investment you can do. But when you go for ETF, you have to buy that day. No SIP. Your particular day you are buying, that's all. Then when you take how buying, see, the mutual funds will declare net asset value at the end of every day. If you send 10,000 rupees today, they will be buying the units at the rate of the net asset value, which is declared at the end of the day. But in an ETF, if you buy at 10 o'clock, it will be different rate. 11, it will be different. At 3 o'clock, it will be different. It will be changing as the market is changing. Similarly, ETF, the expense ratio is low. But one problem with the ETF, if you are going for an ETF, which has got a small corpus asset under management, when you want to sell that ETF, it will be very difficult. There will not be any buyers. So you have to be very careful. But index fund, there is no problem. At any time, you can sell it to the fund house. But here, if the AUM is very small and others, they don't want the particular fund, your liquidity is going to be affected. Some examples I have given, Nifty 50, Nifty Next 50, there are examples for mutual fund. Then Nifty Bs, Nifty Junior Bs, these are all examples for ETF. I am investing in the Nifty Bs for the past 12 to 15 years. I am steadily getting a return of more than 12% Nifty Bs. So Nifty Bs is one of my favorite investment since my early years. So these are all very good investment option. Then when we go into the types of, and I will not go into the details because there is a separate talk on index fund. So for completion's sake, only I am telling all these things. So types of index funds, it can be a market cap based index fund. Nifty 50, what do you mean by Nifty 50? Nifty is an index of National Stock Exchange. Nifty 50 is the top 50 companies which make up the Nifty. That is the top 50 companies. Nifty 50 index fund means you are going to invest in the top 50 companies. Nifty Next 50 means you are going to invest in the top 50 companies which are coming next to the top 50 or next to 50 top companies you are going to invest. Sensex is the index of the Bombay Stock Exchange. Top 30 companies in the market capitalization in India is taken for the Sensex for calculation. So if you are going to invest in the top 30 companies, that is Sensex based. Similarly, mid-cap stocks are, there are 150 mid-cap stocks are there. Nifty mid-cap 150 will invest in all these things. Similarly, Nifty Midcap 50 will invest in the top 50 of the midcap companies. So these are all market cap based index funds. So you can choose this and you can invest. Similarly, that and certain, certain difficult things also value based. They invest in a particular stock whose value is that correct, not overvalued. Or they invest momentum based. When the stock momentum is high, they invest. Or they invest in a stock based on the quality of the company. Or they invest in the companies which are low volatility. Or it can be some sector funds like a pharma sector. So sector funds are there. Or there are thematic funds are there, like agriculture, theme-based funds are there. But for an ordinary investor, these market cap-based investment are the 5, Nifty 50, Next 50, these are all sufficient. Unless you are well-versed with other things, never you can go near factor-based. You can stick on only to market cap-based. Then, now we have decided active investor, passive investor. Then we are going to, what is the investment style? Conservative, less conservative, aggressive. So depending on, we are going to invest. If you are going to be a highly conservative investor, you just invest in Nifty 50 or Sensex based, that is the top 30 companies. Sensex based index fund, that is sufficient. Just invest and forget. You will get very good returns in a long run. You are not highly conservative, you are a little more but conservative. You can invest in Nifty 50 or Sensex based index, and you can invest in the next 50 also. So if you invest in these two, as if you are a conservative investor, then you are a moderately aggressive investor, you are ready to take some risk. So basis same, core portfolio never changes for all the core portfolio for the 3 are same. But if you are moderately aggressive investor, you can enter into the mid-cap space. You can either buy Nifty mid-cap 150 or 50, whichever you want to buy, you can add if you are a little moderately aggressive investor. If you are an aggressive investor, you are going to invest in everything, Nifty 50, Nifty Next 50, Nifty mid-cap 150 or 50, and you are going to enter into small cap index fund also. You are going to enter into international index fund also. So you are going to enter into everything if you are going to be aggressive investor. If you are, even though you are a passive investor, if you are a young person, be an aggressive investor. Younger age is the age where you have to take risk. You must take risk. So you be aggressive investor at a younger age. Then, why many people prefer index fund? It is very simple and easy way to invest and become rich. It is a very good bet for a long-term investment. And as we all know very well, Warren Buffett's very favorite thing is the ETF. And now the index fund and ETF, they are gaining more popularity in the US. And I've seen many articles where they say the passive funds, 80% of the times they give better results than active fund. So if you're chosen to be a passive investor and you are going to invest in index fund, never feel any regret, because you are going to become rich quickly and you are going to earn a lot. Then I'll give some example here. For example, you have invested in Nifty 50 25 years back. At that time, Nifty was 1,000. Today, it has gone to 18,000. So this 25 years, there were ups and downs, but the 1,000 index has become 18,000. What more you need to invest? Then see, 25 years total return index of Nifty 50. 25 years, it has given 14.2% returns in 25 years. What more you need to invest in index fund? These are a list of index fund which you can get in any good net. And I think in next talk, index fund, they'll be giving this. This is if you just watch the 3 years return and 5 years return, you can very well say will definitely get more than 11% return if you invest in a index fund or ETF. Then next step after finishing passive fund. Passive fund, I told you, you are going to invest in index fund or ETF. And the index fund also, you can be highly conservative, moderately aggressive, depending on your category of style of investing, you are going to choose the fund. Then active investor. See, your risk appetite and fund selection. Here also, you are going to select your fund depending on your nature or style of investing. If you are going to be a conservative investor, you invest only in conservative growth fund. What is conservative growth fund? It is nothing but large cap, or it can be index Nifty 50, aggressive hybrid fund. For ATC benefit, you can be any category of any style of category of investor. For ATC benefit, only ELS is the best for any style of investing. So if you are a conservative investor, you go for conservative growth fund, which consists of large cap, index fund like Nifty 50, aggressive hybrid fund. If you are moderately aggressive investor, then you are going for a growth fund. So when I say growth fund, it consists of large cap, or it can be index fund Nifty 50, or Nifty 50 plus next 50, large and mid cap, flexi cap. These three comes under growth fund. So if you are moderately aggressive, you invest these three funds. If you are a young investor, you want to take more risk, you are an aggressive investor, then you go for aggressive growth, global diversification. So what more extra they are going to invest? They are going to invest in mid cap and small cap, and they are going to invest in global funds. So if you are going to be aggressive or a young investor, you invest in everything: mid cap, small cap, large and mid cap, flexi cap, and global funds. So this is very simple thing before deciding which fund you are going to invest. We'll see one by one. See how to allocate. If you are going to be aggressive investor, young investor, aggressive investor, you allocate aggressive growth 15 to 20%. Never allocate 70 or 80% of your money in a mid cap and small cap stocks, because when the market goes down, it will go down still more. It will take long time for it to come up again in the upside market. So your aggressive growth funds like mid cap, small cap, only 15 to 20% only you got to invest. Then growth stocks, growth fund, large cap, large and mid cap, flexi cap, you can have 60 to 70% of your investment. Then ELSs, we all know only 1.5 lakhs every year, we can invest in ELSs. Then international diversification, if you want to go for abroad funds, international funds, that also you limit to 15 to 20%. Because as you know very well, Indian stock market is performing better than in many of the world stock markets. So there is no need for us to have a praise over foreign stock markets. So you can restrict your international diversification to 15 to 20%. So this is going to be the asset allocation for an aggressive investor. Then, so we'll take up one by one. Aggressive growth. See, I have given three funds here in aggressive growth mid cap, three mid cap mutual funds. You just closely watch the 10 years return. I'm not going for, since we have told, mutual fund is a long-term investment of 7 to 10 years. Let us take only 10 years return. Closely watch the 10 years return. It is coming around 18 to 20% in a 10 years return. All the three funds are performing in a good manner. So this is aggressive growth, that is mid cap. Then we'll go for a small cap. Small cap funds, I have given 4 funds here. If you take the 10 years return of these small cap funds, everything has given more than 20%. Or trailing returns, not CAGR, trailing returns. So it has given more than 20% returns, 10 years returns. So all the 4 funds. So aggressive growth, mid cap and small cap. Let us have some carry home message. See, as a long-term investment of 10 or more years, both mid-cap and small-cap funds, they are going to give very good returns of 18 to 20%. But they are little risky, highly volatile. So you restrict your investment in these two category of funds to 15 to 20%. But the last 2 points are my personal views. It may not be everyone's view. See, as far as mid-cap fund is concerned, I invest only through the SIP route, systematic investment plan. But when the Nifty PE is very high, in other words, when the stock market highly in a bull phase, I partially book profit and invest in some other thing. And I continue the SIP. I never stop the SIP. This also I am doing the mid caps. Maybe wrong or right. You check your advisor. And small cap also I follow one thing. I never invest in a small cap mutual fund through a SIP route. I invest only in the small cap fund when it is in a bear phase. And when it goes into a bull phase, I sell it, I take out the profit. So small cap, I buy and sell strategy only I'm following for a very long time. Even I bought Axis small cap for 56 rupees NAV. Now it is trading around 62 rupees. So I buy in a low and sell in a high. That way I manage the small cap because it's highly volatile because I'm doing like this. Then next category we are going. Growth, already I told you it's a large cap, large and mid cap, and flexi cap. I given 3 large cap funds here. You just go through the 10 years return. So all these funds are given 14 to 15% returns, 10 years returns, 3 funds. So this is goodness about the large cap. Then see this top 3 large and mid cap funds. Look at the 10 years returns. It is little more than, since mid cap is there, it is little more than large cap fund. And 10 years fund has given anywhere between 17 to 23% returns in 10 years. All the 3 funds given more than 17 years. So this is little greater than the large cap fund. Then what about the flexi cap fund? Flexi cap fund, they invest in large cap, mid cap, and small cap. And some funds like Parag Parikh, they invest in foreign stocks also. So flexi cap is a flexible cap. So all the 3 things will be there in the flexi cap. So I given 3 things. So the returns, if you see 10 years returns, it is more than large cap, but it is coming less than the large and mid cap. So it is in between large cap and large and mid cap. So 15 to 16% returns. So all the 3 categories has given more than 11% returns or 12% returns. That is very good. If your returns are going to be 14.5% CAGR, then your money is going to double every 5 years. Then, what is the carrier message here? See, in growth category where I told 3 things, you got to invest 60 to 70% in growth. Then, when you invest in a growth type of funds, you have to follow only the SIP route, systematic investment plan. But you can go for top up. When the market is very bearish, when the market has fallen down, you can buy some, you can invest some lump sum in the particular fund. You can do some top up. That way it will be giving more returns. Then if you closely watch, large cap fund has given 14 to 15% returns, and large and mid cap has given 17 to 23%. And flexi cap has given 15 to 17%. So all returns are very good. So almost if you are stay invested in these funds, your money is going to double every 5 years. So for a normal investor, he need not break his head. If you are not a passive investor, if you are an active investor, you want less trouble with the investment, just select 3 or 4 funds in this particular category, which we are talking now. 3 or 4 funds in the category large cap, large and mid cap, flexi cap. and ELSS, of course, for 80C. 3 or 4 funds in the category, that is more than sufficient to safely travel to a financial independence at an earlier age. In place of large cap, you can also choose Nifty 50 or Nifty 50 plus Nifty Next 50. That also you can choose in place of large cap. Why I'm telling this? Many say Nifty 50 is better than large cap. It has given more good returns. So you can anyway you can choose. So this is a carry-home message about the growth funds. Then next we are going for the ELSS fund. ELSS, there is some problem which will come in the next slide. I've given 3 top funds in the ELSS category. ELSS means it's a equity linked savings scheme. If you invest in this 1.5 lakhs, you will get 80C benefit. That is one great advantage. So that is advantage of ELSS. If you closely watch 10 years data, it has given 15 to 20% returns in 10 years. So it is a very good return for a ELSS category. Then what is the carry-home message about ELSS? See, ELSS is the best for the 80C. Next comes the PPF. Why PPF is best? Because the interest is tax-free. Even if you earn only 7% returns in PPF, it's a tax-free return, so it goes to 10%. So next best is PPF. But one small problem with the ELSS, it is a closed-ended fund. Necessarily, there will be locked-in period of 3 years. But now, in the recent budget, there is some announcement. If you are going to choose the new IT option for IT filing, if you are going to choose the newer option, I think the 80C benefit will not be there. So if you are going for a new regime of taxation, just consult your auditor whether you will be availing 80C benefit or not. If there is no 80C benefit, you can better avoid ELSS funds. Then some are having a thought that once the 3 years lock-in period is over, they immediately come out of the ELSS fund. There is no need. If your ELSS fund is performing in a better manner, you continue investing in that same fund. No new investment, continue the investment in the same fund. Let it work, let it earn more. Why should you come out of the fund? So that is my small opinion. Then we are coming to the final part, international funds. See, there are 3 categories. I don't know much about the lot of other categories. I know only about 3 in this particular fund. I invested in 2 things. One is the Mirai Asset, Bank Plus, and Motilal Oswal Nasdaq 100 ETF. I invested in these 2. They both are giving very good returns. The only thing is most of them, they depends on the US market. So it doesn't depend on our market. So the fall or rise depends on the US market. But long-term returns, 10 years returns is not there because many of the funds are very new. Only one fund has got 10 years return of 16%. Then what is the carry-home pay message? So it is a real global diversification. To diversify into globally, that is a very good thing. China and Europe, previously we used to buy China stocks also. China and Europe are not very attractive at present. But US stock market, sheer size of the US market is somewhere unimaginable size. Then companies, US companies, take Amazon, Netflix, or something like that. So it has got a global presence. They are all global giants. When there is a global giants available in our time, why not you buy the share of the global giants? One important advantage, you need not buy one stock like our system. You can buy in a fractional also. 1/5 of the stock, 1/10 of the stock also you can buy. So fraction buying is also possible in US stocks. And returns definitely will be 15 to 20%. It will be a consistent compounder. It will give 15 to 20%. Then you have to be very careful with these things. There is a lot of change in the capital gains. Now they say, unless a fund or ETF, they invest at least 35% in Indian stocks, there will not be any capital gains advantage for that fund. For your entire profit, you have to club it, your taxable income, and you have to pay the tax. So that is a new rule. Kindly check. I'm not very confident. Kindly check with your auditor whether this rule is there or not. If the rule is there, just check whether 35% of the stocks are invested, is invested in Indian stocks. Otherwise, you lose the advantage of taxation benefit. Then finally, we are coming to the conservative hybrid fund. Say I got this SBI equity fund for a very long time. It has given around 12 here, 10 years return is given as 14.83 trailing return, but I get a return of 12% because I got for more than 10 years. It is giving a return of, 12%. So conservative hybrid fund is a very good fund because you are having around 35% of debt and 65% of the equity. So it is a hybrid fund. If you take closely watch the 10 years return, it is not very low. It is very good, 14 and 17. They are very good returns. So presence of debt gives stability to the portfolio. If equity occupies 65% or more, then for capital gains, it will be taken as a equity fund. That is another advantage. And long-term returns are around 13 to 15%. This is ideal for a conservative investor who otherwise will be investing in a bank fixed deposit, which will be giving only 5 to 7% returns. So instead of 5 to 7% return, a conservative investor can earn double the return by investing in a conservative fund. See, I come to the final part. So I have given you 3 important things. One is a goal-based investment, how to build up your corpus. Then what is the risk-based investment? First of all, decide whether you are an active investor or a passive investor. Then if you are anything, you maybe decide your style. You want to be conservative or moderately aggressive or aggressive. After deciding these 2 things, you choose the fund category. Then you choose some fund in that category. Very simple thing, very easily can be followed. Then finally, I have written 4 books on personal finance, investment in mutual fund, art of choosing ideal insurance, then wise investment and investment in shares. So I'll put a final word in this to the talk. See, mutual fund is an ideal inflation beating investment for a long term. For a workaholic person who doesn't have much time to read, investing in a 3 or 4 index fund is more than sufficient. Don't think you are not going to get sufficient corpus. You'll get a very good corpus at an earlier age. Just invest in 3 or 4 index fund. Without much pain, without much work, you can have very good returns in index fund. Number 3, even if you are going to be an active investor, you are a normal person who doesn't want to spend more time in reading the investment journals. Select in a growth type of fund 3 or 5 fund. 3 to 5 funds select in a large mid cap and flexi cap. 3 or 5 funds plus 1 ELSS. That is more than sufficient. Then if you are a young investor, you must be ready to take risk. Without risk, life will not be happy. Life will not be enjoyable. Take some risk. You go for aggressive growth funds. You go for global diversification. So then finally, this is my favorite slide. If your aim is going to be correct, you are going to hit the target. I have already given how to take the aim also. If you are not going to hit the target, the fault lies with you. So thank you very much.
Thank you very much, sir, for your wonderful talk. And I've heard you so many times on this topic. Every time you come up with the very simplified, very easy and updated version of your talk. And that gives us a sort of a idea how much you are reading, how much you are incorporating in your talks and updating yourself. Wonderful talk, sir. Thank you very much for your concluding the part 2 of mutual funds. We do have a lot of questions in our chat box, sir. Let us see if we can try to answer them through you or through our other participants here, or then continue in our WhatsApp group also, sir. Let me start with some of the chat questions, sir.
Sir, I will answer one question, sir. Somebody asked, US stocks has dipped for the last 1 year.
Yeah.
So I told you mutual fund and stock investment is a long-term investment. Never look at the 1 year return. You always look at the long-term returns. Definitely 1 year return, sometimes it will come down, even it will become negative by 10% or 15%. So never bother about all these things. If we wait for 7 to 10 years, finally we'll get a very good returns.
We have an active chat questioner, Dr. Priya Porwal. I will be asking, I think Lady Doctor, her questions also, but Dr. Rajiv has posted an interesting question, sir. Even it is intriguing me. I am investing in sector-based fund, sir. These are cyclical sectors. How can I adjust SIPs if they are underperforming sectors mutual funds?
So my advice is for the youngsters is to stay away from the sector funds or thematic funds. Sector funds, most of the sector funds are cyclical funds. Unless you know the cycle, when the cycle is moving up, when the cycle is moving down, you are not going to earn much in that particular thing. I've already invested in pharma fund, but it is not giving any good returns to me. So unless you understand about the particular cyclical sector, it is difficult to invest in the particular in sector fund. So better to stay away from the particular sector. So I have invested in 2 sectors. One is pharma, another one is digital. Both are not giving good results so far. I waited for 2-3 years, but still it is not improving. So I think it's better to avoid sector funds. Let us keep our investment very simple.
Correct, sir. Actually, Dr. Priya has answered there what you have said. I believe sector-based and thematic funds always to be avoided. At least there is no always anywhere like in our medicine, but it's better to avoid sector and theme-based funds, sir. And she suggested that flexi-cap, what you have mentioned, and a multi-cap is better as they will be diversified both on the sectors and the market caps. Classic example, she also quoted what you said, sir, about the pharma and IT sector. Sir, Anita from Hyderabad, Dr. Anita Channa, she is a senior pediatrician, our colleague here in Hyderabad, very close follower of our programs of F3 and FIP. She asked, sir, I think you have introduced first time, but though we are discussing about this issue in past 1 year, what is a core portfolio and a satellite portfolio, sir?
Core portfolio is you must have in your portfolio. For example, if you take a stock market, there are certain stocks which we call it fondly, we can call it as a consistent compounders. This is a fond word of Saurabh Mukherjee. So the consistent compounders like HDFC Bank, TCS. So there are so many things like that. This must be in your core portfolio. There are certain other stocks which may go up, come down. So there are some risks involved with that stocks. So that sometimes they will be giving very good results. Sometimes they will not be giving very good results. They will occupy the satellite portfolio. So first thing is you have to concentrate on building a core portfolio. After building a core portfolio, then you have to go for the satellite portfolio. You can have both. First, you have to give primary importance to the core portfolio. Then you go for the satellite portfolio.
Correct, sir. Taking this answer of yours little forward, I will add what our another admin and faculty, Dr. Soren, says. Core is about 70% of your investment, probably.
Yes, correct.
And
yes,
25 to 30% of your investment is a satellite. So you can play buy and sell, book profits, buy in dips, sell in high, in the satellite portfolios. Core remains for long term, as you said, and that is your bulk of your investment. But Dr. Priya has mentioned a little offhand opinion. She is saying USA markets are not performing that well, whereas Indian markets are performing, and the future of the next 10 years is also looks like that. So investment in US funds may not be advisable. What do you say, sir?
So for this only we say that your investment is subject to market risk. So definitely, so nobody can make a guess that US economy will come down and Indian economy will move up rather than the US. But I think, in my opinion, in another 10 or 20 years, US economy will still be very strong. Robust economy, I can put a word, robust economy. So it is not going to come down very shortly and very easily. So I think preferable place to invest other than India, I believe only in India. So I invest only very small amount in foreign stocks. So I believe still you can invest in US stocks, especially when it has come down and when many stocks are available at a very cheaper rate, you can buy.
Sir, as to my knowledge, in the stock exchanges of America, there are 60,000 companies listed, sir. And we are not more than 5,000 also.
It's a robust market. So only I put the word robust market, sir.
You said the size of the market is so large, sir. 10 times bigger than an Indian market.
Yes.
Almost. So there are NASDAQ is there, New York Stock Exchange is there, SP 500 is there. There are a lot of exchanges and a lot of categorization, and entrepreneurship is definitely high there. So probably the scope is good. And sir has already mentioned the FANGs stock, Google, Amazon, Facebook, which is known as Metaverse now, Netflix, Apple, Microsoft, Tesla. These are some of the blue chip companies of US. Probably you will be better off if you try to do a long-term vision on investment on these foreign stocks, at least American stocks. Sir, let's go to the next question, sir. Many of us, our friends have mentioned your talk as very excellent, wonderful, simplified presentation. Thank you very much. Very good presentation they have mentioned, sir. Priya is again mentioned about past return is not a guarantee for the future return in the stocks which we have discussed. Understanding the market or understanding the content of the fund is also important, she has mentioned. So which you have also mentioned. 10 years is what you have mentioned, but always it cannot be taken as a gospel truth for future also. So always evaluation of the fund is important, what you have said. Sir, PPFA's FlexiCap, I think you have mentioned. Parag FlexiCap. Yes, sir. FlexiCap is mentioned by Shushmita Pal. She says it covers all aspects of aggressive growth, downside protection due to value investing principles, and global diversification. What's your opinion, sir?
Yes, sir. Really, there are two things I appreciate in Parag FlexiCap fund. Number one, his stock selection will be little different. So if you closely follow his portfolio, the stock selection of the Parag will be little different from others. Number one. Number two, he has invested in foreign stocks also. Now, due to some RBI restrictions and other things, they are not able to follow the particular thing properly. But their stock selection is very good. Their diversification is very good. Then international diversification is also there. So I have confidently invested in Parag.
Sir, Dr. Pawan has announced that there are very few seats left in our WhatsApp group. So kindly join with the invitation link. Sir, mutual fund and PPF comparison, he says. Because ALSS is a market link, PPF will actually diversify our portfolio.
So these two are like comparing male and female. So because PPF comes under fixed income securities, the mutual fund comes under equity investment. So we can't compare these two. If we compare ELSS with PPF, ELSS, PPF has got a tax-free returns. So even if it gives only 7%, tax-free returns will amount to 10%. Second thing, PPF lock-in period is 15 years. But ELSS lock-in period is only 3 years. So better of the two is ELSS.
And both have got different
Different
I think,
entity.
yeah, their usage is different. So PPF is
Yes.
almost like a debt fund now, sir. Yeah. So
See, I invested in PPF for my granddaughter, PPF and Suganya Samriddhi Payana Yojana, each 1.5 lakhs every year I'm investing for her. So she'll be getting, when she attains the age of 18 or 20, she'll be getting around 1 to 1.2 crores for that higher studies or for marriage and like that. So PPF can be used for a long-term investment, especially on the children name also we can open PPF account.
and sir, it is can be extendable now, sir, after 50
Yes, extendable.
years.
Yes, you can extend it.
Yes. Sir, a couple of guidelines. Is direct application of mutual fund is good, sir, or regular application of the mutual fund is good?
Direct will give 1% more returns than the regular one, because regular they are giving 1% brokerage, but a direct there will not be any brokerage at all. So saying I am going only for regular because of so many other reasons which I can't express here. But for youngsters, it is always better to go for direct.
So to go for a direct, either they can go to the mutual fund website, sir, or there is
that also they can do, sir. Otherwise, last time you mentioned that Zerodha coin is very good for direct buy. My camps is there, camps is there. So many things are there. You can go through anything.
And then there is a one good mutual fund website we all know, Association of Mutual Fund of India. They have got so many. Yeah, AMFI, yes.
If you are going for a regular investment plan, your broker should be AMFI certified broker. Otherwise, don't go near him.
Yes, sir. So I think time is lacking, but the questions are unlimited, sir. They are not finished. There are so many questions. I hope our viewers who have seen us today have been benefited by your wonderful talk. And I request you to kindly participate for next 1 week, whenever you find time to answer some questions, some doubts, some advices, some discussion on the mutual fund portfolio management, portfolio build-up, both core and satellite portfolio for at least a week. And I want to announce to our group today that next Sunday, wonderful talk which sir has alluded will be there, which is by none other than our wonderful faculty, Dr. Vipul Jain from New Delhi, sir. We have heard him, we know him, how nicely he has presented earlier talks, and a popular authority on these matters of index fund. So viewers, do not miss this talk of Dr. Vipul Jain, sir. Next week, we have that lined up, and it is better to come for a live session and have a live discussion than rather than just receiving a recorded version, which is always will be available thanks to Dr. R.S.V. Krishna, former secretary and the treasurer of the Twin Cities branch of Indian Academy of Pediatrics, Hyderabad. So next Sunday around 4 p.m. we will have Dr. Vipul Jain from New Delhi with a index fund, a passive fund, which sir has discussed today for a non-aggressive or a highly conservative investor. He will talk on smart way to invest in Nifty. Index fund simplicity is the way to success. That's the topic he gave. Index fund, the simplicity to way to success. So I conclude the session today, sir. And if Dr. Pavan is there, and if Dr. Yashwant Rao, President PATS, is there, kindly say a few words for the closing.
Sir, finally, can I say one word, sir?
Sir.
Sir, I have started my journey in equity in the year 1981-82. But at that time, there was nobody to guide or teach. So I have committed mistakes only. So most of the thing which I invested are all wrong. I have committed so many mistakes. When I started mastering the art of investing, already I have crossed 50s. But the people in this group are very lucky to have our Ajay sir as his mentor. How much pains he is taking to bring different people and forming a group, a WhatsApp group, and giving valuable things, lot of technical analysis. These things you can't get even in Dalal Street magazine. So many very good analytic things are there in our WhatsApp group. So I have to thank two persons. One, Sir Ajay sir for his excellent effort. Second thing, IAP Telangana branch. First, it was started by, our close friend. Now it is being followed by the next group of people. They are doing a wonderful job for the entire pediatric community of not only Telangana, for the entire India. So thank you, sir. Thank you.
Thank you.
I wish you a bon voyage, sir.
Thank you very much, sir. I may not be there in the month of May in Hyderabad because I'm also traveling, but there will be our friends who will be managing the show. And I request Dr. Yashwant, if he is around, or Dr. Pawan, kindly.
Yes, sir. Yeah.
Yes.
Yeah. Thank you, sir.
Dr. Pawan, 1
Sir,
minute. I will, Dr. Pawan,
Malay-
1 minute. Friends, Dr. Pawan is in Australia on family vacation and he's midnight there. And is still with his passion and interest, is online with us and is monitoring the session from there. Dr. Pawan, hats off to you. Yes, Pawan.
With wife attending with
Thank you, sir. Me and my wife both are. Indira is also attending, sir. So it's always, we are very grateful and thankful to Dr. Tirumalai Kolondu, sir. We never misses his talks. As you as rightly said, how many times he speaks. Almost every time it's a new one, what he comes out with. So that shows his passion, and we always love to hear from him, sir. And what Tirumalai sir told about Ajay sir is very apt. I think he is so passionate, selflessly sacrificing his family time and personal time. He is doing this without any selfless. I think the passion I have seen in Dr. Ajay sir is really inspiring us also to continue this program for one more year. So I request all of you to please utilize this. We have nothing to get anything out of these programs by conducting. Only intention, heartful intention is to benefit all the pediatricians. Like, I am also, when I started my mutual funds, I did to a broker, which is a regular mutual fund. And through these talks only, I came to know that how much loss we are going to incur at the end of the tenure by just I switch it from regular to direct. So that has saved me a lot of funds. Whatever the funds which I have invested through agent and all, those are all regular funds which were ratio than the direct funds. So thank you, Sir Kulandu sir, for saving us from such a devastating thing. I think most of the people who are attending this session also, please check it. So if your mutual fund is a regular, please convert it into direct. You will save a lot of money. Regular and direct and growth fund. That is what sir was telling. Yeah, sir. Your suggestion on that, sir, Kolondu sir. I think you might have told that.
Definitely, sir. They have to
direct
go
versus
only for
regular.
direct
1 point.
Growth. That is, two things are very important. So always go for growth fund.
Kolondu sir.
Direct, sir. Yes, sir. You are correct, sir. Direct fund only should be invested, especially our youngsters. They have to invest only through direct route, and that also they have to invest as a growth option.
So, friends, thank you very much. We will try and post the video link of YouTube sometime later. Actually, our senior guide, Dr. Harish Gopal sir, a little reluctant in posting video links because you should actively participate and ask questions. Then only the learning gets at least extended, if not completed, to be there in the live movement. Of course, the video will be available and we'll post the link. Thank you very much. See you next Sunday to Dr. Vipul Jain's talk on index funds. Thank you, sir.
Thank you, sir. Thank you, sir.